Welcome back to the ComLucro channel. If you are applying smart money concepts on your charts, you are probably seeing dozens of setups that look perfect every single day. But here's the problem. Most of those trades still end in losses. Not because your analysis is wrong, but because you are unknowingly trading low-quality setups. The truth is simple. The market does not reward activity. It rewards precision. And that is exactly where most traders fail. They focus on finding more trades instead of filtering for better ones. In today's video, I am going to show you 5 powerful hacks that professional traders use to eliminate weak setups and focus only on high probability opportunities. By the end of this video, you will stop chasing every move and start trading with clarity, structure, and intention. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Starting with hack number 1. Price must originate from a higher time frame supply or demand area. For a setup to be considered high quality, price needs to come from a strong supply or demand zone on a higher time frame, such as the 1-hour or 4-hour charts. This is essential because it helps you understand who is in control of the market. It shows whether buyers or sellers are dominating, and it defines the direction you are actually allowed to trade. For example, if you are looking to buy, price should originate from an unmitigated demand zone on the 1-hour or 4-hour time frame. On the other hand, if you want to sell, price must come from an unmitigated supply zone. Identifying which side is in control is critical, because if you do not know whether buyers or sellers are in charge, there is a high probability you will end up trading against the real market direction. Before moving forward, let's quickly recap how to identify who is truly in control. To determine whether demand or supply is dominant, you need to evaluate the most recent price origin. For example, if the market is trending downward and price originates from a fresh, unmitigated supply zone, then supply is in control, and you should be looking for selling opportunities, not buys. Supply remains in control until price reaches a fresh demand zone and reacts upward. At that point, demand takes control, and you should stop looking for sell setups, even if something appears to be a perfect entry. So identifying control always depends on how price reacts to unmitigated supply and demand zones. Always remember that fresh higher time frame zones carry more importance than the time frame you are currently analyzing. This means that if price taps into a fresh, unmitigated higher time frame zone from the opposite side, control can shift from demand to supply, or from supply to demand. Now moving to hack number 2. We look for a point of interest created by a liquidity sweep. The first thing we want to see is a liquidity sweep, either buy side or sell side, which creates a sharp shift in price direction and eventually leads to a break of structure. This movement forms a high-quality point of interest at its origin, creating a strong probability that price will react or reverse when it returns to that area, giving us a solid trading opportunity. And the reason behind this is simple. These zones represent the footprint of smart money in the market. Price often performs a manipulation by taking out retail traders' positions, and these areas are where large volumes are traded just before a strong move in the opposite direction. That is what makes these zones high-quality supply or demand levels that deserve your full attention. Now, adding more confluence with hack number 3, we look for inefficiency. To strengthen the setup, we focus on order blocks or points of interest that are formed with imbalance and inefficiency. This matters because a clear imbalance between buyers and sellers indicates that significant volume was traded, suggesting smart money involvement. The presence of an unfilled gap above or below a point of interest acts like a magnet, making that zone more sensitive and reliable. Because of this, price is more likely to respect these areas when it returns to them. Moving forward to hack number 4, we identify premium or discount areas. Points of interest located at the extremes of the market always have higher priority than those formed in the middle of a range. In a bullish market structure, you should focus only on demand zones within the discount area, which is the lower portion of the range. In a bearish market structure, you should focus on supply zones within the premium area, which is the upper portion of the range. This approach helps filter out weaker setups and keeps your focus on the areas that offer the best risk to reward opportunities. Finally, we reach hack number 5, which is the presence of a higher time frame liquidity level ahead of price. You need a clear liquidity target on a higher time frame to act as your take profit level. This gives you a defined destination for the trade. This step is critical because even if you identify a high-quality setup, the trade only makes sense if there is enough room for price to reach your target. This understanding helps you define your entry, your take profit, and your risk to reward clearly. It is the final and one of the most important filters that determines whether you should take the trade or stay out of the market, even when everything else looks good. Now, let's quickly recap all 5 hacks. Hack number 1, trade only from higher time frame supply or demand. Hack number 2, look for liquidity sweeps that create strong points of interest. Hack number 3, focus on imbalance and inefficiency for stronger reactions. Hack number 4, operate in premium and discount zones, not in the middle. Hack number 5, always have clear higher time frame liquidity as your target. When all of these hacks align, you have a high probability setup. But here is the real challenge. The biggest difficulty traders face is not just identifying the perfect setup, but knowing exactly how to execute it and where to place the entry. So now let's go step by step into Smart Money Concepts entry methods and understand how to apply them correctly to identify the best possible entry points in the market. Within Smart Money Concepts, there are 3 main entry approaches. The aggressive model, which carries higher risk. The conservative model, which provides additional confirmation before entry. And the ultra-conservative model, which adds even more confirmation across multiple timeframes. Each approach has its own advantages and limitations, so it is essential to choose the one that aligns with your trading style and risk tolerance. Now, let's break each one down step by step. We begin with the aggressive approach. Entering a trade using this model is similar to placing a limit order within a higher time frame supply or demand zone. Imagine you have a perfect sell setup, just like the example shown on the chart, fully aligned with all the rules of a high probability trade. In this case, when placing a short position, your entry should be positioned at the lowest point of the supply zone to manage risk effectively. Your stop loss should be placed a few pips above the highest point of that zone. For take profit, you can target the nearest external liquidity on the same time frame, since that is the expected direction of price movement. Alternatively, you can aim for a higher time frame liquidity level to achieve a stronger reward-to-risk ratio. If you prefer a slightly more refined version of this approach, you can place your entry at the midpoint of the point of interest. This adjustment often improves your risk to reward by reducing your stop-loss distance, sometimes nearly cutting it in half, while increasing your potential return. The main advantage of aggressive entries is that you are less likely to miss opportunities, and you do not need to constantly monitor the charts. However, there are clear disadvantages. This method carries more risk because you are entering without waiting for confirmation of a reversal, and you are not observing how price reacts when it reaches the zone. Now, let's move into the conservative entry model in more detail. In this approach, we use 2 time frames, a higher time frame for analysis and a lower time frame for confirmation and execution. Personally, I prefer using the 15-minute time frame for analysis and then switching to the 1-minute time frame for execution. However, you can choose combinations such as the 1 hour with the 5-minute or the 4 hour with the 15-minute, depending on your trading style. The key principle is that your analysis time frame should be at least twice as large as your entry time frame. To apply the conservative model, we wait for price to reach the point of interest and show a clear rejection. Once that happens, we move to the lower time frame, observe price action closely, and patiently wait for a valid change of character pattern to form. After confirming the shift in market structure on the entry time frame, we place our entry at the lowest point of the newly formed order block. In this case, it would be a lower time frame supply zone created by the change of character move, with the stop loss placed a few pips above the highest point of that zone. For take profit, we target external liquidity on the higher time frame. One of the main advantages of this model is that it confirms a reaction at the point of interest using lower time frame price action. This often leads to a better risk-to-reward ratio due to tighter stop losses. If price invalidates the point of interest and continues moving higher, your lower time frame stop loss can be hit quickly. There is also the possibility of a continuation pattern forming on the higher time frame, or price needing to sweep additional liquidity, which can trap you in the trade. Another drawback is that refining your entry too much increases the chance of missing valence setups. Now, let's move to the third model, the ultra-conservative entry. Imagine you have a perfect sell setup on a higher time frame, such as the 4-hour chart, fully aligned with all the criteria of a high probability trade. The next step is to wait for price to return to that higher time frame supply zone. Then shift to a lower time frame, such as the 1-hour chart. From there, monitor price action and wait for a change of character to form. After confirming this structural shift on the 1-hour time frame, the ultra-conservative process begins. First, identify the supply zone created by the bearish change of character move. Then move down to the 15-minute time frame and wait for price to tap into that 1-hour supply zone and form another change of character. Next, mark the order block formed on the 15-minute chart. After that, drop to the 1-minute time frame and wait for price to enter the 15-minute supply zone, reject, and create one more change of character. Once this is confirmed, identify the new order block and place a sell limit at the lowest point of that zone, with the stop loss positioned a few pips above it. For take profit, you can target either a higher time frame unmitigated demand zone or the current swing low. The advantage of this model is that it provides stronger confirmation across multiple time frames and often delivers a better risk-to-reward ratio due to more precise entries. However, it requires significantly more time and patience, and waiting for too many confirmations can result in missed opportunities. And if you feel like you are still missing something when filtering your setups and identifying high-probability trades, I highly recommend watching this next video. We are about to show you a short clip, and you can find the full video in the cards. In it, I break down how to read market structure, understand liquidity, and apply the CISD strategies step by step, so you can approach the market with a clear and professional mindset. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. If this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand, how markets really behave. Thanks for watching, and I will see you in the next video.